You can make a good trade, read the market correctly, sit through the difficult part, and still give back the profit because you refuse to recognize that the trade had changed. That is one of the more expensive contradictions in trading. The same patience that helps you stay with a sound position can become stubbornness after the market stops confirming it. A profit on the screen creates its own kind of pressure. Once you have seen what the trade was worth, you begin negotiating with the market to get that number back. But the market does not know what you were up. It does not know your best unrealized profit, your target, or how satisfied you felt an hour ago. It only shows you what buyers and sellers are willing to do now. If price begins behaving differently, the useful question is not, how much profit am I giving back? The useful question is the reason for holding still present? That distinction matters because protecting profits is not the same as grabbing them. If you become afraid of losing every open gain, you will cut strong positions before they have room to develop. If you become emotionally attached to every profitable position, you will watch healthy gains turn into small gains, break even trades or losses. The problem is not simply knowing when to sell. The problem is learning to separate normal movement from meaningful deterioration. You have to watch behavior. Suppose a position has been advancing cleanly. Pullbacks are controlled. Buyers respond quickly. Breakouts hold. Then something changes. New highs produce little follow-through. Strength is sold almost immediately. A level that previously attracted buyers begins failing on repeated tests. None of those observations guarantees a reversal. Markets do not offer that certainty. But together, they may tell you that the character of the trade is no longer what it was. That is where discipline becomes practical. Before entering, you should have some idea of what would make the trade wrong, what would suggest the move is weakening, and what kind of normal fluctuation you are willing to tolerate. Otherwise, once profit appears, every small decline feels important and every large decline becomes something you are tempted to explain away. Notice what happens in your own thinking when a profitable position retreats. Do you study price action more carefully, or do you immediately begin defending your original opinion? Do you reduce risk because the evidence changed, or only because the profit number makes you uncomfortable? Those are not the same decision. A trader who cannot tell the difference will often protect the wrong thing. He protects his ego when he should protect capital. He protects a target when he should protect flexibility. And sometimes he protects a small profit so aggressively that he never allows a genuinely strong position to become meaningful. So the real subject is deeper than where to place a stop or when to take partial profits. It is about learning which profits deserve room, which profits are warning you to become defensive, and which apparent signs of weakness are nothing more than the ordinary cost of staying with a good trade. That judgment begins with several signals the market gives before the profit is actually gone, and those are the signals we need to examine next. The moment you see a large open profit, the trade changes in your mind before it changes in the market. Suppose you are up 4,000. A little later the position shows 2,700. You are still profitable, yet it no longer feels that way. The missing 300 begins to feel like money you lost. That feeling is dangerous, because the market never promises you the highest number you happen to see. Once your mind accepts the peak as yours, every retreat becomes personal. You stop judging the position from where it stands and start judging it from where it was. Then a strange thing happens. You may hold longer, not because the trade deserves patience, but because you want the old profit back. That is how an unrealized gain becomes an anchor. Watch your thinking when a winner pulls back. Are you studying the market in front of you, or are you silently waiting for the P&L to return to its best level? If your entire decision changes because you once saw a larger number, you are no longer responding only to price. You are responding to memory. The practical discipline is simple to describe and harder to practice. Separate what the position is worth now from what it was briefly worth before. The high watermark can be useful information, but it cannot become an emotional debt the market owes you. And that becomes even more important when the trade itself begins to change while the profit is still visible. A profitable position can remain above your entry long after the original reason for holding it has weakened. That is what makes this mistake difficult to see. The green number gives reassurance, so you keep calling it the same trade. But a trade is not defined only by where you bought it. It is defined by the behavior that justified staying with it. Imagine you entered because price broke through resistance and buyers kept defending that level. For a while, the market confirms the idea. Then the defense disappears. Price can still be profitable, yet the condition that gave the position its strength is no longer present. At that point, your entry price tells you very little. The important question becomes, if you had no position right now, would the current behavior still support the same idea? That question removes ownership from the analysis. It forces you to examine what the market is doing instead of what your existing position encourages you to believe. This does not mean abandoning a trade whenever one detail changes. Markets are imperfect. Confirmation can weaken temporarily. But when the central condition behind the trade disappears, continuing to hold requires a new reason. That is where traders often get into trouble. They begin with evidence, then remain because of attachment to the original decision, and sometimes the market does not clearly turn against you at all. It simply stops doing what a good trade was supposed to do next. A trade does not have to reverse sharply to become less attractive. Sometimes it simply stops making progress. Imagine price breaks out, moves in your favor, then spends several sessions going nowhere. It is not collapsing. It is not forcing you out. But every attempt to continue higher stalls near the same area. The position remains profitable, so doing nothing feels reasonable. The difficulty is that time carries information. If your trade depended on continued demand, then repeated failure to advance matters. Each unsuccessful push tells you that buyers are no longer gaining ground as easily as before. Meanwhile, your capital remains exposed to risk, even though the expected reward is no longer developing at the same pace. Patience is valuable only when there is something worth waiting for. Otherwise, patience can become a respectable name for inactivity. So watch what the market accomplishes, not merely what it avoids doing. A position that refuses to fall is not automatically strong. Ask whether it is still producing the progress that justified tying up capital in the first place. The question is not, has anything terrible happened? It is this trade still doing enough? There will be times when consolidation is healthy and patience is rewarded. But there will also be times when stalled progress is the first warning that the opportunity is changing. And once movement begins to change, the next problem is deciding how much room that movement should be allowed. A stop that was sensible yesterday can become too tight today, without the trade becoming worse. Suppose a position has been rising in a quiet, orderly way. Daily swings are small, pullbacks are shallow, and a close stop fits the market's normal behavior. Then the range begins to widen. Price is still advancing, but each move now travels farther in both directions. If you keep using the old distance, normal movement can look like danger. That matters because a stop is not just a number below price. It represents how much movement you are willing to tolerate before deciding the trade no longer deserves room. When the market's ordinary range expands, the same fixed distance begins carrying a different meaning. This is where protecting profit can become self-defeating. You tighten the stop because the gain has grown, but the market itself has become more active. The result is that you may remove yourself from a position for behaving normally under new conditions. Watch the size and speed of recent swings. Compare pullbacks with the movement that came before them. Ask whether your protective level reflects actual market behavior or merely your discomfort with giving back part of the gain. A wider range does not mean risk should be ignored. It means the meaning of distance has changed. And once a profitable trade begins demanding more room, another question appears, whether success is quietly tempting you to increase the amount of risk behind it. A profitable trade can make extra risk feel cheaper than it really is. You begin with a position sized according to your plan. It moves well. Confidence rises. Then you add more, not because the new entry offers the same quality as the first, but because the existing gain makes the additional exposure feel protected. That is where judgment can loosen. Open profit is still your capital at risk. Yet once it feels like market money instead of your money, you may accept decisions you would have rejected at the start. A larger position, a weaker entry, or more leverage suddenly seems reasonable because the trade has already paid for it. But the market does not separate your original position from the new risk you added. If price turns, every unit participates in the reversal. What looked like a comfortable winner can become fragile because the exposure grew faster than the quality of the opportunity. So when you increase size in a winning trade, examine the reason carefully. Would you take that new piece as a fresh trade at this price? Does it meet the same standard, or are you using accumulated profit to excuse a lower one? Adding to strength can be disciplined. Adding because success has made risk feel harmless is something else. And even when you decide to reduce exposure instead of increase it, another problem appears: what exactly is the remaining position supposed to do? Selling part of a winner can feel disciplined, even when no real decision has been made. You take half off, lock in some profit, and feel immediate relief, but now the remaining position sits there without a clear job. Is it being held for a larger move? Is it supposed to survive a deeper pullback? What evidence would justify closing it? If those questions were never answered, reducing size has changed your exposure without improving your thinking. That matters because partial exits can hide indecision. The first sale removes enough pressure to make holding easier, but the remaining shares often become emotionally neglected. You tell yourself they are free to run, as though realized profit has removed the need to manage them. It has not. The remaining capital is still exposed, and every unit should still have a reason for being there. Before taking something off, decide what the smaller position is meant to accomplish. Perhaps one portion was intended for a defined objective, while the rest was meant to participate in a longer move. Then the reduction has structure. Without that distinction, you are simply cutting the trade into pieces and hoping the smaller size makes the next decision easier. A partial exit should clarify the position, not postpone the question you were unwilling to answer. And once every remaining piece has a defined purpose, you have to look beyond the individual trade and ask whether your supposedly separate winners are actually carrying the same risk. 5 winning positions can look like diversification while all depending on the same thing. You may own different stocks, different sectors, even different markets. On the screen, they appear separate. But if they are all benefiting from the same force, easy credit, strong technology sentiment, a rising commodity, or aggressive risk-taking, then one change in that force can affect every position at once. That is the hidden danger of correlation. Each trade can look healthy on its own, right up until the common support beneath them weakens. Then several profits begin retreating together. What seemed like 5 independent decisions reveals itself as one large directional bet divided across several symbols. So protecting profit requires another level of observation. Do not only ask what each chart is doing. Ask what all your winners have in common. What market condition is paying you? What happens to the whole group if that condition changes? This does not mean closing positions simply because they move together. It means recognizing that the number of positions does not tell you the number of risks you actually have. Sometimes reducing one trade changes little because 4 others still carry the same exposure. The useful decision is not merely which position looks weakest, but how much of the same underlying idea you are willing to keep. And there are risks that become even harder to manage because the market may not give you a continuous price at which to respond. Some profits look protected only because the market is still giving you continuous prices. A stop can work well while trading is orderly. But before earnings, a major economic release, or another scheduled event, the next available price may be far from the last one. If the market gaps through your intended exit, the protection you thought you had was never guaranteed. That changes the decision. The question is no longer only where you would exit if price moves against you. It becomes whether you are willing to carry exposure through a period when you may not control the exit price at all. A profitable position can still face that risk, and the size of the open gain does not reduce it. This is why event risk should be judged separately from ordinary market movement. You are not predicting whether the news will be good or bad. You are deciding whether the possible jump in price fits the amount of uncertainty you are prepared to accept. Before holding through a known catalyst, ask what happens if the market opens well beyond the level you expected to use for protection. Would the position still fit your risk limits under that outcome? Sometimes the correct choice is to keep the exposure. Sometimes it is to reduce it. The important point is that the decision must be made before continuous trading disappears. And even when price remains fully tradable, the market can begin weakening long before the chart looks obviously broken. A market can stay near its highs while the quality of the advance is already deteriorating. That is why price alone can be misleading. The important clue is often not where the market stands, but how it responds when given a reason to move higher. A strong market usually makes progress easily. Good news attracts buying, breakouts extend. Small setbacks are absorbed without much effort. Then the response begins to change. A new high appears, but buyers cannot carry it far. A strong opening is sold quickly. Favorable news produces only a brief advance. Each upward push requires more effort, yet achieves less distance. Price may still look respectable, but the relationship between effort and result is becoming less favorable. No single sign proves that a reversal is coming. That is not the point. The value is in the pattern. When several favorable situations repeatedly fail to produce favorable results, the market is telling you something about the strength behind the move. Train yourself to notice reaction, not just direction. When buyers are given opportunities, what do they accomplish? When sellers appear, how easily are their offers absorbed? Is strength creating more strength, or is it beginning to disappear almost as soon as it appears? A profitable position can remain visually healthy during this transition, which is precisely why the change is easy to ignore. And once you notice that change, the next difficulty is deciding what an exit actually means. One reason traders hold too long is that they treat an exit like a prediction. They think that if they sell and price keeps rising, the decision was wrong. That belief creates a very high standard for action. Now you are not simply deciding whether the current reward still justifies the risk. You are trying to prove that the move is finished. But an exit does not have to carry that burden. You can close a position because the situation no longer deserves the same exposure, even if the market later moves higher. The future path does not erase the logic of the decision made with the information available at the time. This matters because the need to be right about the top creates hesitation. You wait for clearer evidence, then clearer evidence again, because selling feels final. By the time certainty arrives, much of the flexibility may already be gone. Ask yourself a harder question: are you holding because the trade still deserves capital, or because you cannot tolerate watching it rise without you? Those are different motives. Closing a position is not a declaration that the market has nowhere left to go. It is a decision about whether you still want your capital exposed under the present conditions. If the market later creates a fresh opportunity, that can be judged separately, and that distinction becomes even more important when the price level that matters most to you is not a level the market cares about at all. The entry price can become emotionally important long after it has stopped being important to the market. A trade moves in your favor, and you immediately move the stop to break even. It feels disciplined. Now, you tell yourself the trade cannot hurt you. But the market does not know where you entered, and it has no obligation to respect the price that makes you feel safe. That is the hidden problem. Break-even often becomes a psychological boundary rather than a market boundary. You are no longer asking how much movement the position can reasonably tolerate. You are asking for protection from the embarrassment of turning a winner into a loser. Those are different concerns. Suppose price advances, then returns to test an area below your entry before recovering. If that movement is normal for the setup, a break-even stop can remove you for no reason except that your fill price happened to sit in the way. Before moving protection to entry, ask what has actually changed. Has the market created a meaningful level there, Or are you simply uncomfortable allowing the position to become negative again? Your entry matters for accounting. It does not automatically matter for structure. The discipline is to separate those two facts before they become one decision. Otherwise, you may protect the feeling of having been right more carefully than the trade itself. And once a trade moves farther into profit, another temptation appears, changing the destination simply because success has made you want more. A target often looks reasonable until price gets close enough to make greed persuasive. You entered with a clear objective. Perhaps the next resistance area offered a sensible place to take profit. As price approaches it, however, the trade feels stronger than it did at entry. The gain is visible. Confidence rises. Suddenly the original target seems too modest, so you move it farther away. There is nothing wrong with changing an objective when new evidence justifies it. The problem begins when the only new information is that you are making money. Profit can create the illusion that a larger outcome has become more probable simply because a larger outcome has become more desirable. That is how a planned exit turns into a moving finish line. Watch the reason behind every target adjustment. Did the market actually open a better path? Clear resistance? Stronger continuation? Improved structure? Or did the number on the screen simply make you reluctant to stop wanting more? If the evidence changed, the plan may deserve revision. If desire changed, the trade has not improved at all. This distinction matters because a target that keeps moving can never be reached. The market advances. Your expectation advances with it. And eventually a normal retreat begins before you have decided what was enough. And as the profit grows, traders often make another subtle mistake. They start watching the position through a much smaller lens than the one that justified the trade in the first place. A winning trade can become harder to hold simply because you start watching it too closely. You may have entered from a daily setup, expecting the move to develop over several sessions, but once the profit becomes meaningful, your attention shifts. Now every 5-minute dip matters. Every small rejection looks important. The trade has not changed, but the lens you are using to judge it has. That creates a mismatch. A position built on larger structure will always contain smaller movements against you. If you suddenly manage it from a lower time frame, normal noise begins to look like evidence. The more closely you watch, the more reasons you can find to interfere. So the question is not whether lower time frame information is useless. It is whether that information has the authority to overrule the framework that created the trade. Before entering, know which time frame defines the opportunity. Then decide what kind of evidence is strong enough to alter that view. If you change time frames later, make that change deliberately, not because the growing profit has made every tick feel expensive. A trader who watches too closely often believes he is becoming more precise. In reality, he may be replacing one coherent decision process with a stream of smaller emotional reactions. And even if you keep the right time frame, the market itself can still change from a trending environment into something very different. A profitable trend does not have to turn sharply against you before the character of the market changes. Sometimes the advance simply loses direction. Price begins moving back and forth through the same area. Breakouts no longer travel far. Pullbacks recover, but the recoveries do not lead to fresh expansion. The market is no longer clearly rising, yet it is not clearly falling either. That middle state matters. A trend rewards patience because movement keeps carrying price away from prior levels. A balanced market behaves differently. It repeatedly pulls price back toward the center of the range. If you continue managing a trend position as though directional expansion is still present, you may keep giving back profit while waiting for a continuation that the market is no longer offering. The practical question is not, has the trend reversed? It is this still a trending market? A watch whether price is making sustained progress or merely rotating. Notice whether breakouts are being accepted or quickly pulled back into the prior range. The distinction is important because the same position can carry a very different payoff once the market stops rewarding directional exposure. You do not need to predict the next major move. You need to recognize when the environment that paid you has shifted into one that behaves by different rules. And when that happens, the next issue becomes more mechanical. Even a good exit plan may fail if the market cannot absorb your position cleanly. A profit can look precise on the screen, while the actual exit is anything but precise. Suppose you are holding a large position in a thin market. Your stop is clear. The chart gives you a clean level. But when selling begins, there may not be enough demand at that price to take all of your size. The first shares get out near the level you expected. The rest may not. That difference is liquidity risk. Your exit plan assumes somebody will be there to take the other side. When the position is small relative to normal trading activity, that assumption may be reasonable. When your size becomes large relative to available volume and depth, the market itself becomes part of the problem. So before admiring an unrealized gain, ask a less comfortable question. How much of this position could actually be sold near the price I am using in my plan? Look at spread, normal volume, depth, and how quickly price moves when larger orders appear. A theoretical stop means little if the position cannot be converted into cash near that level without moving through several prices. This is why execution has to be considered before trouble begins. Liquidity can disappear fastest when everyone wants the same exit, and even when a position remains easy to sell. Another risk can grow quietly without any new purchase at all. The winner itself can become too large. A position can become dangerous without you ever adding another share. You may enter with sensible size. Then the trade keeps rising while the rest of the account changes very little. What began as one controlled position slowly becomes a much larger percentage of your total capital. That is concentration created by success. The difficulty is psychological because the position earned its size. You did not become reckless at entry. You simply allowed appreciation to keep increasing the amount of your account tied to one outcome. Cutting it back can feel almost irrational because you are reducing the very trade that has treated you best. But past performance does not reduce present exposure. If one position now represents a large part of your account, a normal correction in that single trade can have an outsized effect on profits already accumulated elsewhere. The question is no longer only whether the position still looks attractive. You also have to ask what happens to the account if this one winner experiences an ordinary setback. Watch position weight as the trade develops. Compare its current size with the role you originally intended it to play. A position can remain excellent and still become too important. That is a different decision from predicting a top. It is simply recognizing that success can change the structure of your risk. And once you begin protecting gains this way, another danger appears, protecting them so aggressively that you damage the very payoff pattern your trading method depends on. A trader can become so determined to protect every gain that the strategy itself stops working. Imagine a method built around a simple reality. Many trades will produce little, but a few may travel far enough to pay for the rest. If you keep taking profit the moment a position becomes uncomfortable, you may improve the appearance of individual trades while damaging the larger pattern. That is the trap. A small realized gain feels safer than an open profit that could shrink. But if your method depends on occasional outsized winners, repeatedly cutting those winners short-changes the mathematics of the whole approach. You are not just managing risk, you are changing the distribution of outcomes. This is why profit protection cannot be judged one trade at a time. A decision that looks sensible in isolation may be harmful when repeated 50 times. Before tightening every winner, ask what role large gains play in the method you are actually trading. Are they optional, or are they the part that offsets the inevitable losses and ordinary exits? The point is not to hold everything endlessly. It is to understand what your process needs in order to retain its edge. Once you see that, a harder question appears: what happens after a profit is finally realized, when success itself begins changing the quality of the next decision? A profitable trade can end well and still damage the next decision. You close the position, book the gain, and feel lighter. The pressure is gone, but confidence has changed. A setup that looked mediocre earlier now appears acceptable because you are already ahead. the profit begins acting like permission. That is where selectivity often slips. The next trade may be smaller, faster, and less carefully chosen. You tell yourself there is room for one attempt because the earlier winner created a cushion. But the market does not grade the second trade more generously because the first one worked. A weak setup remains weak. This is how realized profit can quietly lower standards. The useful question after a strong trade is not, how much can I afford to risk now? It is, would I take this next trade if the previous one had never happened? That removes the emotional effect of being ahead and forces the new opportunity to stand on its own evidence. Watch for the urge to stay active simply because the session has gone well. Success can create the same loss of discipline that frustration creates, only with a more pleasant feeling attached to it.